This video continues the discussion of the economy and budget of the late 1990s, and this is part 2 on revenues. The questions to answer are: what caused the tax revenue spike of the late 1990s and 2000, and what is the effect of the tax revenue spike of 2000 on the budget projection? Moving to tax revenues, you will see the most interesting and fascinating part of the Clinton economy, and that is the fluctuation and increase in tax revenues from 1995 to 2000. 1995 is important because that's the year Netscape went public and began the dot-com era. And you will see how 1995 started the beginning of the revenue spike of the so-called Clinton economy. Here is the 1962 to 2007 tax revenues and GDP trend line. And you can see in 1995, the tax revenues started to increase faster than the GDP trend line, and that continued till 2000. And then it reversed trend line until 2003, and starting in 2003, it has essentially grown with the GDP trend line slightly faster to up to even or slightly above the GDP trend line in 2007. So how did the rate of increase in tax revenues to the GDP leading from 1995 to 2000 occur? The CBO included this statement in the 2001 revenue section. It said from 1994 to 2000, however, the annual growth of tax receipts surpassed that of the economy for reasons unrelated to new tax legislation. So tax legislation was not the answer. In 2001, the CBO stated, under one scenario, the economy has simply experienced a temporary divergence from stable long-term trends and will shortly return to the trend it followed from about 1973 through 1995. Returning to the 1962 to 2007 tax revenues and GDP trend graph, you can see this scenario the CBO talked about in 2001 is eventually what happened. As revenues departed starting in 1995 from the GDP trend line up to 2000, then reversed trend down to 2003, and have essentially returned to the standard that was set from 1962 to 1995, where tax revenues essentially tracked with GDP. So all this discussion on how the Bush tax cuts led to the decline in revenues from 2000 to 2003, this graph simply does not support that theory, because the same tax cuts were in effect from 2003 to 2007 when tax revenues have returned to the GDP trend line. So essentially what we have is exactly what the CBO anticipated in 2001, that we have returned to the stable long-term trends of what that was established from 1973 through 1995. Where did the tax revenues come from? The CBO cites sources, two of which are the capital gains taxes and higher earnings from individuals in higher income tax brackets. Let's take a look at a source of the capital gains tax revenue. What we know was that the NASDAQ peaked in March of 2000 at a record high level of over 5,000 and high volume. In an attempt to evaluate the potential for capital gains tax revenue, I prepared this graph. With capital gains tax revenues being a function of volume and price increases, I multiplied the two together to come up with what I call the NASDAQ factor. So this graph plots the NASDAQ factor against the nominal GDP trend line and the individual, corporate, and estate taxes. As you can see, the NASDAQ factor explains part of the deviation of the tax revenue line from the nominal GDP line. Also of interest, the NASDAQ factor and the revenue both peaked in 2000. This graph supports the CBO statement that capital gains played a part in the tax revenue increase from 1995 through 2000. And as stated earlier, 1995 is the year Netscape went public. So now let's look at the income increases amongst the wealthy. The CBO said in 2001 in the 5.6 trillion surplus budget projection said the baseline economic assumptions reflect recent favorable developments for the budget, including the concentration of income growth amongst people with higher tax rates. So from 1995 to 2000, the fact that the rich were getting richer was a good thing, at least as far as the budget was concerned. Here's a graph of the 1993 to 2005 taxpayer thresholds, inflation adjusted to $2,000, and you can see in 2000 the top 1% peaked at slightly above $300,000, and there were also increases in the top 5% and top 10%. And under our progressive tax system, That resulted in those taxpayers paying more tax dollars. In other words, more tax dollars were being generated for each dollar increase of GDP. So the CBO's statement that the budget improved because the income concentration occurred amongst the wealthy is confirmed through this graph. And the real irony of the whole budget discussion over the last several years is one of the reasons the budget surpluses could not be maintained is because the rich could not maintain their income levels. So you can see from the previous two graphs the peak in the capital gains possibilities and then the peak in the adjusted gross incomes of the top earners resulted in a spike in tax revenues in the year 2000. And of course the earnings fell off after 2000 and dipped down to 2003 and then have since recovered up to in 2005, 2006. So what effect did these spikes in revenue have on the budget projection in 2001, projecting the 5.6 trillion budget surplus? Here's a graph taken right from the 2001 CBO report that projected the 5.6 trillion. And you can see in the top line up there that it has the individual income tax, and we know that it peaked in 2000, and you can see on that line in 2000 how that spiked line was projected forward from there on to for the next 10 years. And the same was for the Social Security taxes, and the same with corporate income taxes, but the primary spike occurred in individual income taxes, and that spike was projected forward for 10 years. And as you can see in this graph, the individual earnings declined from 2000 down to 2003. So even if the Clinton administration individual tax rates would have been maintained, there would have been less tax revenues generated. Unless, of course, you're ready to take on the argument that a cut in income tax rates leads to a decline in earnings. Among other things, the next video is going to focus on this sentence in the 2001 CBO report. At the end of the Clinton administration, the CBO said the following: "The primary negative risk is that the current slowdown might turn into a recession." And they went on to say, although forecasters widely anticipated that economic activity would slow, the deceleration has been surprisingly rapid. So we're going to focus on what these sentences mean to anybody who read this report.